a man who really needs no introduction. Most of you have probably heard Jerry speak at one time or another. You probably know him. I have pages of stuff on Jerry's bio, but we talked right before this, and he asked me just to highlight a couple things and skip all of the presentations he's made and all the articles he's written and all the professorships he's had and past positions. But wanted me to mention that he is currently working with Meltzer, Lippy, Goldstein, and Whitestone. Am I saying that right? In New York City, because he's still so busy that he needed the support staff. He's of counsel with a number of firms, including Orange County's own Jeffrey Verdon Law Group, right across the street. He's also the director of the Notre Dame Tax Institute, which is November 10th and 11th of this year. And been to that conference. It's an excellent conference that's in South Bend typically, but I think it's all virtual this year. Is that right, Jerry?
I haven't decided whether to pull the plug yet.
Okay. Okay. Michigan graduated from law school, God, way back in, would you say 2002? So anyway, today Jerry's going to talk about using installment sales with non-grantor trust for estate and income tax planning. So give it up for Jerry.
All right, today's presentation, I actually at the last minute added something based on the generational split dollar case called Estate of Levine, because everybody thought it was a wonderful taxpayer victory. There it is, Notre Dame, tentatively scheduled to be live in South Bend, Indiana, but given everything at the end of the month, at the end of May, we'll probably decide to pull the plug and have it virtual again, which means anybody around the country can attend it virtually. The only advantage of if it's live, it's the Thursday and Friday before a home Notre Dame football game. But if it's virtual, that's out of the question. In any event, I was originally scheduled to give this presentation last February for your annual meeting, but that got canceled. So here I am. Craig said, why don't you schlep out to Orange County in April? And it was very easy to do so. Okay. So interestingly, the generational split dollar case was pretty straightforward. And it was the first case where there were no bad facts. Remember, the other generational split dollar cases, Morissette and Cahill, all had bad facts, so that it was fairly easy for the IRS to win those cases in tax court. What happened is, very simplistically, Mrs. Levine, the senior generation, and we always call G1 the parents, G2 the children, and G3 the grandchildren, so it's easy to follow. So G1 provides an irrevocable trust for the benefit of her descendants, G2 and G3, with $6.5 million under a split dollar agreement called the Economic Benefit Agreement. And the trust used the $6.5 million to pay the premiums on a life insurance policy and insuring the lives of the next generation. So basically, under the split dollar agreement, under the economic benefit regime, G1 was entitled to receive the greater of the premiums paid, which was $6.5 million, or the cash value of the policy. And we know that after a number of years, the cash value of the policy will grow in excess of $6.5 million. So in effect, the fact that it's a deferred payment obligation, the growth in the cash value is the practical equivalent of the interest you would get on the loan. Okay. Now, what happened is Mrs. Levine died within a year or two after she advanced the money. And the question in that case was very simple. Well, actually, there's two questions: whether everything should be included in the gross estate under some legal theories. And the second question was the value of the reimbursement right. Now, the judge in the tax court case did not want to spend 4 or 5 days on a valuation trial. So he forced the IRS and the taxpayer to stipulate to the value of the reimbursement right. And the IRS was so confident they would win on the legal issues that they figured, we'll stipulate. So they valued the reimbursement right in Mrs. Levine's gross estate at $2.2 million, which means it was an asset included in her gross estate. So the estate took an income tax basis in the reimbursement right of $2.2 million. And then what happened was, so essentially $4.3 million of value, because what happened is Mrs. Levine lent $6.5 million of cash to the trust. So she had a right to receive the practical equivalent of $6.5 million in cash, valued at $2.2 million. So we essentially had $4.3 million of value disappear, which is really cash. So it's the practical equivalent of getting a discount on cash. And so happened is 40% of 4.3 million. So the estate tax savings was $1.7 million. So the question becomes, now everybody was saying, oh, it's a wonderful victory for the taxpayer, but the IRS never litigated the valuation question. And I can guarantee you for future generational split dollar cases, they're not going to make the mistake of stipulating it. And I can tell you, based on what I've seen, that a typical valuation discount in a generational split dollar case, the IRS will kind of talk about 30 to 40%, but they'll start lower at 20%. But you got to have good facts. You can't make all the mistakes of having bad facts as they had in the previous cases. But let's look at the income tax consequences. And for very simple purposes, the estate has an income tax basis in this reimbursement right of $2.2 million, okay? Now, at the time of the tax court case, the cash value in the policy was $10.2 million, okay? So what are the income tax results if, for example, the insured died in 2023 and the trust receives an income tax-free death benefit of $20 million, and the cash value of the policy at that time was $10.5 million? Well, the split dollar agreement says that when the insured dies, which was G2, the sponsor, G1 or G1 successor, is entitled to the greater of premiums paid, which is $6.5 million, or the cash value of the policy. So under the split dollar agreement, the trust must use $10.5 million of the death benefit to pay the reimbursement right. So with a $2.2 million basis, the reimbursement, the successor to the reimbursement right receives $10.5 million. Well, guess what? I invest in an asset at 2.2 million. I get paid 10.5 million. Isn't that a gain for federal income tax purposes? Yikes. The generational split dollar transaction is not a complete estate planning windfall. It is just a deferral mechanism. In other words, on that $4.3 million of disappearing value, it will definitely get paid back in the future. Now, the point is that that means it will get paid back and gain will be reported because 6.5 million exceeds 2.2 million by 4.3 million. Now, it turns out, I think the theory is that since this isn't a promissory note, that gain will be a long-term capital gain. And I think there's a good rationale for that position. Nobody has addressed it yet, except what I did over the last few days is add this in. Now, here's the point is, if we didn't do a split dollar agreement, all 20 million would have been income tax free. So by converting, using the economic benefit, what we have done is we've got the deferral of the estate tax, at least on the 4.3 million of value, which is reported as capital gain. But here's the key is the 6.5 million, but the trust got, the successor got 10.5 million. So the extra $4 million is reported as income. So the key here is the longer you let this split dollar agreement stay in existence and the cash value builds up and builds up, the more income will be reported. And the problem here is that extra 4 million over the 6.5 million, if you never do the transaction, none of it would have been reported as income. So you got to be real careful in explaining all of the future income tax consequences to the client when you do one of these generational split dollar transactions. Because if you don't explain it, and then the accountant tells the estate or the success or the children, by the way, there's all this income tax gain to report, and you didn't explain it to the client, is there a possibility the client will say, you never told us this, you better notify your malpractice carrier that you might have a claim? But all I'm saying is you have to understand the generational split dollar transaction is a deferral mechanism only. And the nice thing is to, as soon as the sponsor dies, to use the trust should somehow terminate the split dollar agreement and pay back $6.5 million as quickly as possible before the cash value exceeds the 6.5 million. That way you get the deferral, you get a deduction of estate tax at 40%, and that 4.3 million is capital gain taxable at 20%. So not only you get the deferral, but you get the difference in the income tax rates and the estate tax rates. So I just wanted to point that out to everybody. Yes, Mr. Albrecht. Yes. Unfortunately, on the loan regime, and this is why I'm saying we should only do economic benefit now, on a loan regime, that's a debt obligation. And if you have a debt obligation to pay you $6.5 million of stated principal, and the basis is 2 million, that's a market discount debt obligation. And under section 1276 of the code, the entire 4.3 million is ordinary income. So don't do the loan regime anymore, do the economic benefit regime, because at least instead of it being ordinary income, it'll be capital gain. And I just wanted to throw that in. Now, for those of you who have no life, on Monday morning, the IRS issued proposed clawback regulations that basically said a lot of people thought that if they do a $12 million taxable gift today, with the gift tax exemption being 12 million, and they die later when it goes back to like 6 or 7 million, you're going to get the benefit of 12 million. Well, if you do an outright gift of 12 million, it's okay. But if you do any of the variations of it, you're not going to get the clawback. And that's what those proposed regs do. And if anybody has trouble falling asleep at night, pick up those proposed regulations, and I guarantee you, you will have no trouble falling asleep. Okay, so I just wanted to point that out to everybody. So let's really get into, why am I not, we got a problem here. I'm not advancing. Well, basically, if you have like, you do a Cupid and you have a taxable gift, and your taxable gift is like 12 million, and then you die with the Cupid included in your gross estate, you're only going to get the exemption in existence of 7 million. So you're not going to get the rest of it. And if you do like the same thing with a GRAT, if you don't zero out the GRAT. Okay. What are we going? I'm in trouble. Well, that's it. We can end this early. All right. No, that's, okay. Okay, so let's go. All right, so what we're going to do is talk about non-grantor trusts. Because people have always been using grant, after 1985, people started saying we should only use grantor trusts. And they forget that non-grantor trusts have certain advantages that grantor trusts do not have. Now, a grantor trust, when somebody forms a grantor trust and transfers all sorts of income producing assets into the grantor trust, the grantor, for federal income tax purposes, has to report all of the trust's income. And if the grantor is in the highest marginal income tax brackets, like, and we love California for income tax purposes because of, they have this wonderful 13.3% state income tax. So if you throw that onto the 37.37 rate and the 3.8% surcharge in California, your tax on income in California is like 53%, which is better than Florida, because when I do income tax deferral, it's more advantageous. That's why I love California as opposed to Florida. Higher income tax rates. Now, by the way, I can't tell my clients that I like high income tax rates, but the higher the income tax rates are, the more work I have. That's like, do we really want to see an elimination of the estate and gift tax? No, we won't tell anybody. All right. But using non-grantor trusts funded with income producing assets allows you to have the flexibility to assign income that would otherwise be taxable to the grantor at the highest income tax rates to taxpayers in lower income tax brackets. So let's take a real simple situation. Client funds a $12 million taxable gift of an income producing asset, marketable securities, and the trust is situs in a state with no state income taxes. Now, we don't use Nevada as much because the clients don't want to pay for a Nevada trustee and they live in Florida, so they like to use Florida trusts. Okay. So basically, if that income is accumulated in the trust and not distributed, and it's a Nevada trust, Nevada cannot currently tax that income. So non-grantor trusts situs in a jurisdiction without a state income tax can basically not expose the income producing assets to state income taxes. So we don't, these incomplete gift trusts are too complicated to explain. So I like to use regular completed gift trusts because it has an estate planning advantage as well. Now, the other thing we're going to talk about is there are a lot of individuals who have appreciated assets and they intend to sell them while they're alive. Well, if they intend to sell them while they're alive, they're not going to get step up in basis at death. So is there a way to defer the reporting of the gain on the sale of an appreciated asset for cash while you're alive? In other words, income tax deferral is very important. And the problem is estate planners do not realize the opportunity to do income tax planning for their client. Because most of the time, like here's a situation I had. I got a call from an individual last month. We basically have an operating business. Someone is going to offer us $80 million for the business that we formed, and we're going to have $80 million of gain. You talked about income tax deferral. And I said, yeah, what can we do? And I say, when are you going to sell the business? And they say, next month. Well, the point is, there's a lot of income tax deferral transactions that are sanctioned under the Internal Revenue Code that require waiting periods. Well, guess what? What area do clients actually come to you far in advance? Estate planning. An individual's got a closely held business and he says, you know, I want to do estate planning for it. And I think when I'm retiring, since my children aren't interested, we're going to sell the business. That's a perfect opportunity to incorporate the income tax planning into the estate planning. But you can't do it with an installment sale to a grantor trust because there's no gain on that situation. So we're going to basically show how I can use complex non-grantor trusts for income tax deferral and still accomplish an estate planning objective. Okay. All right. Now, the only thing is when you want to create a complex trust that's not a grantor trust, you can't have your spouse as a beneficiary of the trust. And you can't be a beneficiary of the trust at all. So basically, and if we want to use the complex trust, not only for income tax deferral, but to distribute income to taxpayers in lower income tax brackets, it has to be a non-grantor trust. All right, so here's something interesting, and this is very practical. Suppose grandfather wants to set up a trust for the benefit of their 6 grandchildren, okay? The children have filled their function. What's the children's function, Mark? Grandchildren, right. How many grandchildren do you have now? So you're very happy. Good, glad to hear that. Okay, now, Rick, how about you? 2. And are you funding their college educations now? Why not? All right. Okay. All right. So basically, we have something called the kiddie tax, which basically says if you're a minor child and you have passive income, that passive income is taxable to the minor child using the parents' income tax rates. Well, the kiddie tax, by the way, allows a minor child under the age of 18 to have up to $2,300 of investment income and not be subject to the kiddie tax. So what that means is if you have a minor child and you have like a complex trust and you have like 6 grandchildren, you can assign $2,300 of passive income to the minor child, which will have an effective federal income tax rate of 5%. And in California, the first $9,000 of income for state income taxes is only taxable at 1%. So by assigning income to a minor child, you can reduce the effective rate from the grantor's high rate to an effective rate of 6%. So let's see how this works. Well, interestingly enough, a minor child who's claimed as a dependent on their parents' tax return, there's no personal exemption, but they get a standard deduction of $1,150. In addition, in the progressive income tax rates, the first $1,150 is only taxable at 10%. So basically, let's see how this works, okay? So we have 6 grandchildren. Every year, the trust distributes, it's a complex trust, and in a complex trust, if the trust distributes its income to the beneficiaries, the trust gets a deduction for it and sends a K-1 to the beneficiary who has to report the income. So he's got 6 grandchildren. So he has income producing assets, and it produces 6 times 2,300 is $13,800 of ordinary income that would otherwise be exposed if this was a grantor trust to the federal rate and the California rate, an effective rate of 54.1%. By treating it as 6%, okay, but if the grandparents had to report it at their high rate, that would be $7,400 of income taxes. But by having it in the $2,300, gets a standard deduction of $1,150. Taxable income is $1,150 taxable at 10% federal and 1%. So the total tax on that $13,000 of income will be $126 as opposed to the $74.65. So every year there's an income tax savings by assigning income to taxpayers in a lower income tax bracket of $6,637. Now, you don't have to be mega wealthy to do this. You know, the grandparent, and by the way, the grandparents, they want to help the grandchildren anyway. So this is a nice way of assigning income to minor children who are in a lower income tax bracket through using so let's look at the situation. Let's suppose we have a complex non-grantor trust with gross income of $42,750. It gets a deduction for distributing the $2,300 to the 6 grandchildren. So it gets a deduction of $13,800. And then it has adult children who are in lower income tax brackets. So it distributes $1,560, $1,600, and then it gets a $100 standard deduction. So essentially, the trust is left with $13,450. Now, a trust reaches the highest income tax rate for income in excess of $13,000. But the first $13,700 is taxable at an effective rate of 24%. So leaving some income in the trust, which doesn't get up to the 37% bracket, is still advantageous. And the nice thing is the 3.8% surcharge that applies to passive income doesn't apply to passive income until your passive income exceeds a threshold of $60,000 or $80,000 or $100,000. So essentially, using non-grantor trusts is a very effective way using distributions to assign income to taxpayers in lower income tax bracket. Oh, by the way, what are the effective rates on capital gains for federal income tax purposes? Well, if you notice, for a married couple, the first $83,000 of their capital gains is subject to a 0 income tax rate. And capital gains in excess of that up to $517,000 is a rate of 15%. And it's only when you get income above the 517 that it's subject to the federal capital gains rate of 20%. So even capital gains, I can assign a certain amount of capital gains to taxpayers in lower brackets up to $83,000 and not have any capital gains tax. So this is very practical, and you don't have to be worth 20, 30, 40 or $1 million to take advantage of this, okay? All right, now, here's what's interesting. When most individuals establish trusts, if they want their spouse to be a beneficiary of the trust, it can't be a complex trust. It has to be a grantor trust. So the first thing is senior spouse cannot be a beneficiary of a non-grantor trust. And by the way, senior cannot be a beneficiary of a non-grantor trust initially, okay? And senior beneficiaries can have special powers of appointment, but senior can't have a special power of appointment. So if senior creates their own complex trust, the spouse can't be a beneficiary, senior can't be a beneficiary, and senior cannot have a special power of appointment. But what if somebody else creates a trust for the benefit of senior? So senior can be a beneficiary of the trust, which means so let's suppose senior's parents create a trust for the benefit of senior, senior's spouse, and senior's descendants. And it's not a grantor trust as to anybody. So it can be, so senior can use it. So if senior's parents create a trust for the benefit of senior, spouse, and senior's descendants, that is not a grantor trust. That's great. Now, a lot of people have existing non-grantor trusts where they're a beneficiary of. Well, this can be very useful. Oh, so by the way, so what you should do is, if senior wants to be a beneficiary of the trust and have his spouse be a beneficiary and have a special power of appointment, have somebody other than senior create that trust with a gift and trust. It's very simple. Now, the only thing is, senior comes to you and he's like Rick Albright's age. And of course, what? All right, we'll use somebody older. Oh, Mark. All right. Well, wait a minute, Mark, you have no gray hair. Oh, okay. All right. All right. So essentially, so if some, and now, but the spouse does, it doesn't have to be created by senior's parents. It can be created by senior's brother or sister, or basically one of senior's children. So the key is, if I wanted to create a non-grantor trust and still be a, if I wanted to use a non-grantor trust for all my purposes, I can do that if someone else creates the trust for me. Now, this is not a beat it, because a beat it makes the beneficiary a grantor of the trust, and I want a non-grantor trust. But that means I can fund the trust with greater than $5,000. All right. So the key here is, okay, now let's take a simple situation. Senior owns a family business valued at $30 million. Okay. Okay. And senior's basis in the family business is $20 million. Senior is age 66 and plans on retiring in the future. And senior expects that over the next several years before senior retires, the business could double in value. And senior's exit strategy, since none of the children are interested in the business, senior's exit strategy is to sell the business for cash at retirement. Okay. Now, the estate planning lawyer's first reaction is, I'm going to discount the asset because it's a closely held business, and I'm going to use an installment sale to a grantor trust. But unfortunately, no gain is reported, and the grantor trust takes senior's $20 million basis. Check it. All right. All right. Okay. So what about using an installment sale to a non-grantor trust? So basically, we'll say let's do a 33% valuation discount, which is not unreasonable for a non-voting interest in a closely held business. So senior sells the business to a non-grantor trust for $20 million. Now, the trust doesn't have 20 million, so the trust gives senior a $20 million interest-only promissory note. Well, the trust now owns the business, so the trust will have the funds to pay the interest to senior. Now, so basically, well, let's suppose that senior then, through a series of installment sales by senior and senior's spouse, they sell $20 million of the family business to the trust. Now, there's all sorts of rules on installment sales. These rules on installment sales, which convert capital gain into ordinary income, or say you can't use the installment method on sales to related parties, and all sorts of other rules, apply to the installment method. The installment method rules apply to gains realized on the installment method. Well, we don't have any gain in this situation. So none of the restrictions that apply on the use of the installment method to defer the reporting of the gain apply. So in this situation, the trust paid $20 million. Senior's basis in the business is 20. Senior has no gain. Now, all right away, we have shifted 10 million of value through the discount, because the trust just paid, through the use of the discount, 20 million for a business that's worth 30 million. So basically 10 million of value is out of senior's estate. Now, here's the key, is this has an income tax advantage because in this situation, oh, I'm sorry, this has an estate planning advantage. In addition to the 10 million of value that I shifted by selling a $30 million business for 20 million, let's suppose that the 30 million is earning 5% or $1,500,000. And the interest on that 20 million note at 2% interest is 400,000. So basically the trust reports 1.5 million of income, gets a $400,000 interest expense deduction, which senior has to report as interest income. So the trust income before distributions is $1.1 million. That's the financial leverage of this sale because basically the trust is borrowing money at 2% annual interest and it's earning 5%. So the trust keeps the spread on the annual income. So it's not just the appreciation in value that's shifted to the trust, but a significant portion of the annual operating income. Now, the trust has $1.1 million of taxable income. The trust is going to be in the highest marginal income tax brackets. But as I showed you, since it's a non-grantor trust, the trust can distribute portions of that income each year to the beneficiaries of the trust who are in lower income tax brackets, such as seniors' grandchildren that take advantage of the kiddie tax rules. And also, the only drawback is that senior isn't paying the income taxes on the trust income. So you don't get the burn from grantor trust status. But again, when you do a taxable installment sale to a non-grantor trust, you have the ability to use the non-grantor trust to have the trust make distributions to assign income to taxpayers in lower income tax brackets. And if you put it in a state, the trust in a state with no state income taxes, such as Florida, okay, I'll say Nevada. All right, you might not have state income taxes now. So now let's take a situation where there's gain. Senior owns a 25% interest in an operating business, and under the buy-sell agreement that senior has with other seniors, other co-owners, the value of the business is worth $64 million. So 25% is 16 million. So senior has a 25% interest in the business worth 16 million. Okay. Can I hold people over like I do in class? What? All right. Okay. We'll give you extra credit for class participation. All right. All right. So basically senior has 14 million of built-in gain. And senior has a buyout agreement that says when senior retires, he is required to sell the business to his other co-owners for the then value of the business. So, and senior says, hey, enough is enough. I'm tired of, and senior says, well, what is the impetus for what do you want to retire? He said, in the old days, without cell phones, no one could reach me. Now, I can't give anybody my cell phone number because they call me at nights and weekends. Enough is enough. What? Okay. I like the old days when we didn't have the, emails and everything. And someone said, where's my document? And I say, oh, I put it in the mail. Haven't you gotten it yet? Now they say, email it to me. Fax machines, I would say our fax machine is broken, but you can't even use that excuse anymore. All right. So here's the key. Senior basically sells his 25% interest in the family business that has a market value of 16 million. Now, I'm not going to take any discounts because if I discount it, then I have less gain to report, and this is to defer the gain. So I don't want any discounts. I want to actually sell it for 16 million. So senior sells the 25% interest for a series of $16 million interest-only promissory notes with all principal due, say, in 20 to 25 years from now. So senior realizes a $14 million capital gain, does not have to report the gain under the installment method. By the way, the installment method is a method of accounting. And it basically says, when you report the gain, senior has realized the 14 million gain, but doesn't have to report that $14 million gain until the note matures 20 years from now. So basically, now the non-grantor trust purchased the asset from senior for $16 million. So its cost is the liability it issued, or 16 million, but it acquired it by purchase. So its holding period begins on the date the trust purchased it. Okay. Now, if the trust later sells, senior retires a few years later, and under the buyout agreement, the trust, which now owns the 25% interest, is entitled to $18 million. Well, the trust paid 16 for the asset, sells it for 18. So the trust has 2 million of gain to report. But wait a minute, can seniors, wait a minute, I got a typo there. It's 14 million a gain, right? Hold on. Wait, seniors base 14 million a gain, and I put down 12 million there at the bottom. That's a typo, okay? Seniors 14 million of gain. Well, under the installment method, senior doesn't have to report that gain until the interest on the note is paid. Doesn't this sound too good to be true? Senior sells the family business to a related party, this family trust, and senior defers the gain, the 14 million a gain for 20 years, and the trust gets a 14 million cost, a 16 million cost. So the trust only reports 2 million a gain. Can senior continue to defer that $14 million a gain for another 18 years, the entire 20 years? Doesn't that sound too good to be true? And Congress said, yes, that's too good to be true. So Congress enacted a rule that was very effective. Congress basically enacted a rule. It's called the anti-rushing rule, which was enacted in the Installment Sales Revision Act of 1980. And here's a code section. And this is what it says. If a seller who sells an appreciated asset to a related party defers the reporting of the realized gain under the installment method, and the related party resells the asset purchased from senior anytime within the next 2 years, the gain senior previously deferred under the installment method is immediately accelerated on that second sale. Why was this effective to eliminate using these related party installment sales? And when did the client come to you to say they're going to sell the business? And did they come to you? And when did they tell you about the pending sale to a third party? Up front. It's going to happen next month. So basically, Congress said if the trust resells the property anytime within the next 2 years, the gain is accelerated. That effectively killed everybody who comes to you at the last minute. The key here is it's a safe harbor. The statute basically says all that the related party trust has to do to resell the asset is wait 2 years. Well, senior just came to you for estate planning, said, when I retire a few years from now, and the gain, and I'm going to have to report that gain, he already told you we can wait the 2 years. And what happens if somebody, you're thinking about selling the business, and somebody is interested in selling the business? Do you have to sell it to them now? You can say, if they're interested now, Maybe they'll be interested 2 years from now. So you have the ability to control when the related party resells it. Especially, and how many people here have done buy-sell agreements for their clients? Okay, have you ever mentioned this ability, the 2-year installment sale to them? Why not? Exactly. And you got to get that information because they say, I can't sell the business. I want to get stuff because I have all this gain to report. If I can defer the gain, it's huge. And by the way, they come to you at age 65. Would they be more interested in estate planning or current income tax planning? Right? Yes. Well, the buy-sell agreement, basically, the buy-sell agreements always have provisions allowing you to transfer the interest for family planning purposes to a trust. You got to make, if you have restrictions in the buy-sell agreement, remember the buy-sell agreement is a contract between two parties, so you can always have all the parties amend the contract. All right, but it's a good point. There's a lot of details you have to remember. Now, okay, what is a related party? Well, here, remember, a related party is a creature of statute. And the installment sale rules adopt the related party rules found in another code section. And that other code section basically says that related parties are brothers and sisters and spouses and descendants and parents. Notice who is not mentioned as a related party, Jeff? Did you do one of these? Did you have someone sell for a trust who had no children and said, I'm leaving everything to my nieces and nephews? And we didn't have to worry about the 2-year it was not a related party, so we didn't have to worry about the 2-year resale rule. But she intended to wait a while anyway. But we said in case an offer comes along immediately. So these are just, the key here is estate planners have the best opportunity to do income tax planning for their clients because they come to their income tax lawyers at the last minute. And that's the key. Yeah. I don't. Oh, the question is, what happens? You can set up a trust for the nieces and nephews and give the trust protector the power in the future to add children or other related parties. And because this is so clean, is if the IRS sees that, okay, they're going to question it. And technically it works, okay? But to be honest with you, I like to do it without having, the little extra stuff that the IRS will frown upon. I like to say to the client, the IRS is here, knows everything in the file, knows everything we talked about. But that's a point. Like you have a trust for the benefit of your children, and you give the trust protector the ability in a Nevada trust to add you as a beneficiary far in the future. Technically, that works. Okay, but if you don't have to use it, I prefer not to use it. It's just a question of, but the point is, does the client really need to be a beneficiary of this trust? Yeah, I know. I just, it's too cute. But technically, it works. Okay. Yes. You mean the 10% myth? Okay. Basically, no, the bottom line is, if you ever look at the income tax reality of sale cases, there's a Supreme Court decision that said 100% non-recourse financing where the purchaser had no risk of loss and had nothing, no skin in the game. And the Supreme Court said, we'll respect that as a legitimate sale. It's a Supreme Court case called Clay Brown versus Commissioner, decided in the 1960s. The 10% minimum funding is something that was created in a private letter ruling by Burl Abbin. And Burl will tell you, the IRS said, how about having a 10% gift into the trust? And Burl said, fine, but there's no legal authority for that. And if you look at the income tax cases, there's a number of income tax cases involving 100% non-recourse financing where the courts upheld the validity of that sale. Okay. Well, well, that's because there was someone who was doing beat its with $5,000 and insisted that I write that article. No, I wrote it at the insistence of Dick Oceans, remember? All right. So now here's the problem is, okay, there's a special rule in the Internal Revenue Code that says, where is it here? Okay. There's a special rule in the Internal Revenue Code which says that if you have an installment sale greater than $5 million, any gain on the excess over $5 million, you have to pay deficiency interest on what would be the taxes on that gain. So if I have a $7 million installment sale, the first $5 million of the gain is not subject to this deficiency interest charge. But you compute what the taxes would be on a 2 million capital gain. If they're 500,000, okay, you have to pay deficiency interest of 5.25% on that 500,000. So every year you would have to pay deficiency interest on that excess gain that's deferred. And because it's deficiency interest, you can't deduct it for federal income tax purposes. But this is a nice safe harbor rule. Remember, I have a sale for 16 million, and I'm going to basically do more than 5 million. So basically, husband and wife are separate taxpayers for federal income tax purposes, even though they file a joint return. So what we do is, and by the way, that special interest charge rule only applies to sales that occur each and every year. So what we do is very simple. Husband, okay, so basically, the husband uses a marital deduction, okay, to give half of the business, worth 16 million, to their spouse as a marital deduction tax-free gift with carryover basis. So now the husband has $8 million and the wife has $8 million. So the husband and wife each sell their interests for 5 million each in 2021, and the two additional 5 million sales or two $3 million sales on January 1st, 2022. By the way, it's for the taxable year, and the taxable year artificially ends every December 31st. So basically, I can have $20 million of installment sales with no special interest charge. So in that situation, rather simplistically, I have avoided the special interest charge rule because I can do, you have to have a spouse to do this, but 10 million a year, each and every year. And one time we had a client up in Boston. He had five auto dealerships, each worth about 10 million. And he said, I've had enough. Running an auto dealership is nights and weekends. As anybody who's been, you know, you go to the auto dealership, they're open nights and weekends, and somebody's got to be there. He said, about 7 or 8 years from now, I'm going to retire and sell them all out. So we did a series of 5-10 million installment sales over the next 5 years, and we met the 2-year safe harbor. Now, okay. So interestingly enough, by the way, you can't use an installment sale to defer the gain on the sale of marketable securities. Okay? And then there's another rule that says if you sell depreciable property to a related party, the gain you automatically have is ordinary income. And there's another rule that prohibits the use of the installment method for your section 1245 recapture gain, which I'm not going to go into in detail. But so in this situation, what we do here, again, to review, is we basically, senior sells the business in a series of 4 separate installment sales over 2 years. The trust gets a 16 million basis. Senior's 14 million of capital gain is all deferred, and the trust waits the 2 years. Okay. So basically, in this situation, what we have to do is structure it so we have 2 taxpayers with 2 5 million sales this year and another 2 sales next year, because it's an annual thing each and every year. Okay. So in February of 2025, after waiting the 2-year holding period, senior retires. The trust receives 18 million in cash. Upon redemption of the 25% interest, the trust reports and pays taxes on only 2 million a gain. So, and by the way, there's been an estate freeze at 16 million because that was the sale, and they can continue to defer the reporting of the 14 million gain for another 20 years using the installment method. So you can see in this situation, the trust has a 2 million gain, and I'm assuming they're not in California, so state income taxes are only 5%. So the state income, the federal and state income taxes are 500,000. The trust got 18 million of cash. After paying the tax, the family trust for the benefit of the children now has $17.5 million of cash earning income instead of having to pay the tax on the 14 million. Now, one thing is there's no step up in basis for that installment note owned at the time of death because the gain has been realized and it's called income in respect of the decedent. So you can see in this situation, basically, and you want to illustrate this to the client, the trust has 18 million of sale proceeds, pays 500,000 of tax, 17.5 in net cash, pays 360,000 of interest on the notes. The trust is left with 17,140, okay, to invest. Now, let's suppose the trust invests that extra cash at 6%. So that's the income they earn, less the interest. There's taxable income, less the income tax. The trust has 400,000 of net cash to spend. Now the trust has, that's the trust, 400,000 of net cash. So the California Department of Insurance, I had to add this in for them. Can the trust use the 400,000 to pay annual premiums on a life insurance policy? And the answer is yes, without having to make any annual exclusion gifts or any taxable gifts to the trust. So with that, that's about it. Yes.
Jerry will take some questions, but one came from the virtual viewers. Jerry, can you briefly repeat the question here? How long can you defer these?
Okay. Now, this is a subjective question. There is no statutory prohibition on the length of the note. And there are situations where people have done 30 to 40-year notes. What I like to do is look at guidance in other areas. For example, when C corporations make loans to shareholders, the IRS issued proposed regulations under Code Section 382 that says if a C corporation makes a loan to a shareholder to avoid, the double tax. And the note term is greater than 20 years. The IRS says we're going to treat that as disguised equity and disregard the loan. That is in proposed regulations, and 20 years is a pretty good safe harbor. You want to go out 25 years, okay, 30 years, it starts to look like a retained interest in a trust. That's a subjective factual determination. And the bottom line is, if you want, the client basically says, I want to do as much tax savings as possible, but I don't want to be audited. So you say 30 years is a little bit aggressive, 20 years is very conservative, 25 years might work, but it's a factual question. Now, the key is what happens if for some reason the trust doesn't pay any interest on the note? What's going to happen then? What? Well, if you didn't respect the note and didn't pay the interest, why should the IRS respect the note? So basically, when you do these transactions, absolutely make sure that the interest is paid timely each and every year. It's very important. Yes, Rick. Oh, you mean the deferred sales trust that the IRS basically issued a CCA saying they don't work and has gotten the custom? Stan Crow scam? Well, you know what happened to Stan Crow? Not yet. He might join this guy named Rubel, who did the Son of Boss transactions, who's now wearing an orange jumpsuit. What happened is these deferred sales trusts was a gimmick that was designed to, there's an exception for the interest. If you pledge an installment obligation as collateral for a loan, there's a rule in the Internal Revenue Code that says the loan proceeds will be deemed to be a payment on the note and the gain will be reported. But there's an exception for farm property. If you sell farm property to a related party for an installment note and defer the gain, you can pledge the installment note as collateral for a loan and not accelerate the reporting of the gain. That only applies to farm property. So these deferred sale trust promoters forgot about the farm property exception and kind of said it works for everybody. Now, what happened to, what's his name again? Stan Crow. The Department of Justice sued him and got all of his client lists. And they spent 2 years fighting it. And finally, the Court of Appeals in Idaho affirmed, and he had to turn over all of his customer lists to the IRS. Now, why did the IRS want all of the clients who did that? They're going to be audited, every single one of them. But the point is, here's what's interesting. Let's take a very simple example. I have a $10 million asset with a zero basis. And if I sell that for 10 million of cash, I have $3 million of income taxes I'm going to pay. So I have $7 million to invest after taxes. So what if I sell the business to a third party who's not a related party, and they give me a $10 million installment note, say at 5, 6, or 7% annual interest? And they bought it for 10 million. They're not a related party, so they can resell it and basically have the cash to invest to pay the note interest and principal. Well, here's the key is I basically am getting a 6 or 7% rate of return, not on the 7 million after tax proceeds, but the 10 million of promissory note proceeds. So a legitimate deferred payment sale to an unrelated third party allows me to get a rate of return on the 10 million rather than the 7 million, and then I report the gain. Okay. But you can't really pledge the promissory note as collateral for a loan. Okay. So those deferred sale trusts, and there are legitimate third parties that will buy the property from you. And what they do is they take the sale proceeds and basically put it in and put that sale proceeds as collateral for payment of the loan. So you know there's always the collateral there. And what they're basically doing is buying the property for 10 million, giving you an interest rate and earning more than the interest rate on it. That's how they do the transaction. But those are legitimate. But when you see someone who says you can access all the cash indirectly through our standby letters of credit, watch your wallet. Okay. All right. And they're all under audit now. Okay. Anything, any other questions? Well, thank you. It's a pleasure being here.